What if just zero point 0.1 Bitcoin could eventually pay your monthly bills without you ever selling it? That sounds irresponsible, maybe even delusional. 0.1 Bitcoin is not a full coin. It is not early retirement money. It is not a lottery ticket. For most people, it feels small, manageable, ordinary. So the idea that such a fraction could somehow cover rent, food, utilities, and life itself without being sold sounds like clickbait at best and financial fantasy at worst. And that reaction is exactly the point. Because when people hear "pay your bills," they automatically imagine income, salary, dividends, yield, cash flowing into a bank account every month. They imagine spending the asset, liquidating it, turning it into currency. But what if that assumption is wrong? What if paying your bills does not require selling the underlying asset at all? What if the power is not in consumption, but in position? Not in income, but in leverage? Not in how much Bitcoin you spend, but in what holding a fixed piece of a scarce system allows you to access over time? Before you dismiss the claim, consider this. The world does not reward ownership equally. It rewards strategic ownership. And 0.1 might be more strategic than it looks. So is this some kind of passive income trick that turns 0.1 Bitcoin into a monthly paycheck? No. And if that is what you are expecting, reset your expectations right now. This is not staking. It is not yield farming. It is not some hidden platform promising 12% returns paid in tokens you have never heard of. There is no magic interest button. There is no secret compounding strategy that multiplies your coins while you sleep. When I say without selling, I do not mean generating cash flow out of thin air. I mean something far more structural. Selling converts your position into currency. Borrowing preserves your position while unlocking liquidity. That difference is everything. Traditional finance has used this structure for decades. Wealthy individuals do not liquidate their best assets every time they need money. They use those assets as collateral. They access liquidity against them. They keep ownership intact. The core idea here is not yield. It is capital architecture. If 0.1 Bitcoin becomes a high-quality collateral asset in the future financial system, then its utility expands beyond spending. It becomes something you hold, not consume. Something that grants access rather than disappears. This is not about earning interest. It is about designing your balance sheet differently. What if Bitcoin was never meant to be spent, but to be pledged? Most people still think of Bitcoin as digital cash, something you eventually convert into fiat to pay rent, buy groceries, or fund your lifestyle. The mental model is simple. Buy low, sell high, spend the profit. But that framework assumes Bitcoin's highest function is transaction. What if its highest function is collateral? In traditional finance, prime assets are rarely sold. Real estate, blue-chip stocks, large equity positions. They are pledged, used as security, leveraged carefully to unlock liquidity without giving up ownership. If Bitcoin matures into a globally recognized scarce asset, its role shifts. It stops being pocket money. It becomes balance sheet money. Instead of asking, when do I sell my 0.1 Bitcoin? The better question becomes, when can I borrow against it safely? Spending destroys the position. Collateral preserves it. That difference compounds over time. If the asset appreciates across years while you access limited liquidity against it, you maintain upside exposure. You remain inside the system instead of cashing out of it. This is the mental inversion. Bitcoin is not just something you use. It can become something you anchor your financial structure to. Why do the wealthy almost never sell their best assets? It is not because they do not need money. It is because selling triggers consequences, taxes, loss of upside, reduction of ownership. Once an asset is sold, the compounding engine stops. Instead, many high-net-worth individuals follow a simple structure often summarized as buy, borrow, die. They acquire appreciating assets. They hold them long-term. When they need liquidity, they borrow against those assets rather than liquidating them. The debt is serviced strategically. The asset continues appreciating. Ownership remains intact. This is not crypto magic. It is balance sheet management. Real estate investors refinance instead of selling. Equity holders use portfolio-backed lines of credit. Founders borrow against their shares rather than dumping them on the market. The logic is straightforward. If the asset grows at a rate higher than the cost of borrowing, selling becomes inefficient. Now apply that mental model to Bitcoin. If 0.1 Bitcoin becomes a high-quality, appreciating collateral asset, then the same structure can apply. Buy the scarce asset. Borrow conservatively against it when necessary. Preserve the position. The key is not dying financially before the asset matures. It is surviving long enough for the structure to work. So can 0.1 Bitcoin start paying your bills next month? Number. And this is where realism matters. For this structure to work, several conditions must align over time. First, the asset itself must appreciate significantly. If 0.1 Bitcoin remains small in absolute value, it cannot support meaningful borrowing capacity. Collateral only works when the underlying asset is large enough to matter. Second, liquidity must deepen. Mature lending markets need to exist. Regulated custodians, competitive interest rates, clear legal frameworks. Borrowing against Bitcoin has to become as boring and standardized as borrowing against real estate or equities. Third, volatility must be managed. If the asset swings violently, lenders demand high collateral ratios. That reduces how much you can safely borrow. Stability increases efficiency. And finally, time is essential. Appreciation does not happen overnight. Infrastructure does not mature instantly. This is not a one-year play. It is potentially a 10-year horizon. The model only functions when Bitcoin transitions from speculative asset to recognized macro collateral. Until then, 0.1 Bitcoin is just a position. With time, scale, and institutional acceptance, it can become leverage. But without those conditions, it remains potential, not income. If the strategy is so simple, why do most people fail to hold long enough? Because the real enemy is not volatility, it is psychology. Markets fluctuate. That is normal. What breaks people is pressure, unexpected expenses, job loss, medical bills, social comparison. The quiet voice that says, just sell a little. You can always buy back later. Lifestyle inflation makes it worse. As income rises, spending rises with it. Fixed costs expand. Commitments multiply. Suddenly, 0.1 Bitcoin is no longer a long-term position. It becomes a backup emergency fund. And emergency funds eventually get used. Then there is fear. When the price drops 30%, 40%, 50%, the brain does not think about 10-year horizons. It thinks about survival. It thinks about regret. It imagines total collapse. This is psychological warfare. The market tests conviction repeatedly. It rewards patience but punishes emotional reactions. Most people do not lose because the asset fails. They lose because they sell under stress. The structure only works if you remain positioned, and remaining positioned requires margin in your life, low fixed costs, emergency reserves, emotional discipline. The strategy does not break because Bitcoin crashes. It breaks because humans panic. So what actually pays your bills if you never sell your 0.1 Bitcoin? It is not magic, it is not passive income, and it is not guaranteed wealth. What pays the bills is the system maturing around the asset. It is price appreciation over long stretches of time. It is deeper liquidity. It is competitive lending markets. It is your ability to access a small portion of value without destroying the underlying position. The mechanism is simple. but demanding. Hold the scarce asset. Allow it to appreciate as adoption grows. Gain borrowing power as collateral markets strengthen. Access limited liquidity when necessary. Repeat without collapsing the structure. Hold. Gain leverage. Access liquidity. Repeat. That is the architecture. But it only works if you combine it with patience and restraint. If you overborrow, you get liquidated. If you sell too early, you exit the compounding cycle. If you treat it like a lottery ticket, you break the system yourself. 0.1 Bitcoin does not print money. It gives you optionality inside a growing monetary network. The real question is not whether it will pay your bills. The real question is, are you building income or are you building position?